So whenever you're
Awesome.
ready.
Hi, my name is Peyton Simon, and I am joined by my group members Cameron Lewis and Jack Larson, and we will be presenting on General Motors Company, GM, for as a proposal as an addition to the UWL Gordon Spellman Fund. Now I will pass it along to Jack, and he'll just give us a little bit of a roadmap where we're going to take you over the next 20 minutes or so.
Thanks, Peyton. So overall, we're going to recommend that we should buy some shares of GM. We believe that the GSP is underweight in consumer cyclical, and there also is no exposure into the electric vehicle market as well. So right now, GM is currently priced at $58.72 a share. The target price that we figured out was $65.37 a share, which would end up being a target return of 11.32%. Basically, we think that GM is pretty undervalued compared to its competitors in the industry. This is just basically the main reason that we're going to be recommending a buy. So as you can see here, looking at the figure one, GM price over the last 5 years has steadily increased, more so as of late. This is definitely a good trend that we like to see. Looking at figure two, we can see that PE ratio is slowly going up, but we'll go into more in depth later. But basically, compared to competitors, this is pretty undervalued. Especially with Ford and Toyota and those other companies. Return on equity is also looking very strong for us, which is what we love to see. And then looking at the bottom graph, the growth of $10,000, we can see that GM has actually outperformed the S&P 500, which is amazing to see. Also outperformed Ford and Toyota. So it's just pretty strong in the market, and it's just performing pretty well so far. So just a little outline of what we're going to be going over today. Just a quick business overview along with some revenue breakdowns, and then we're going to go through some of the main financial information, as well as some key growth drivers such as electric vehicles and GM Financial. After that, we're going to go through a quick valuation, go over some risks, and then ultimately give you a recommendation along with how it fits into the portfolio, and then just kind of a quick wrap up, a quick summary of everything that we went over.
All right, thank you, Jack. So just to give a quick overview of GM, for those of you who have not heard of GM before, it is the largest automaker in the world. It's one of the original big three U.S. automakers based in Detroit, Michigan. And its business is the design, manufacture, and sale of cars, trucks, and automotive parts across the globe. It operates in 5 main business segments. The first 3 really make up the bulk of the revenue, over 99%. So we're going to focus more on those 3, but I'll touch on the last 2. First segment, GM North America. It is all car sales, manufacturing based in North America, mostly the U.S., especially in the U.S. GM International does the same thing, except everywhere else, especially in Asia and South America, but not Europe, as I'll explain in a second. And then the third segment is GM Financial. GM Financial is the captive automotive financing arm of the company. It provides retail loans and leases to consumers financing their vehicles. The fourth segment is corporate. This really deals with fleet sales on a wholesale basis to, say, daily rental car companies or organizations. This makes up a very small portion of revenue. And the fifth segment is cruise. Now, this one only makes up 0.1% of revenue, but this one's kind of intriguing. I'm just going to touch on it here. We don't go into it super in depth just because it is very small at the moment. But this is the subsidiary of GM that deals with the development and deployment of autonomous vehicles and ride-sharing technology, among other things. So there's a lot of growth potential in this specific segment that could materialize over the next 5 to 10 years, especially. GM is really leading the charge when it comes to this type of technology. But since it's so small, we're not going to touch on it too much in this presentation. Just to draw your attention to figure 4, this gives you revenue and growth by segment. As you can see, GM North America makes up a very large proportion of GM's total revenue. And then GM Financial makes up a much smaller portion, but a growing portion over the past 5 years. And if you look at the revenue growth rates there, everything's falling. Now, that may seem alarming to you, but we really don't think it is. And here's why. Because GM's really made a commitment over the past 4 years to narrow its focus on its core business, on its most profitable business, bringing cars to the American people. So actually in 2017, GM closed the sale of its Opel and Vauxhall units to Peugeot, the French automaker. This essentially eliminated GM's exposure to Europe. And then over the past 3 years, it's been closing facilities in Australia, India, Thailand, and the like, because the Asian market is extremely competitive with a lot of low-cost providers, and it just wasn't profitable for GM. So while the falling revenue may look like a red flag, we really don't see this trend continuing because GM has been focusing on its core business and really leveraging the strengths of its operations there. And just a quick industry growth rate, IBIS World projects 16%, 4, 3, 2, and 1% respectively growth rates over the next 5 years as the economy continues to recover coming off the COVID-19 pandemic. And now I will pass it back to Jack.
Thanks, Payne. So here we're looking at the revenue streams for 2019 and 2020, and you can see that total revenue is falling a little bit. This isn't really a huge concern in our opinion because this is mainly due to GM closing some of their facilities in Asia that were not very profitable. Like Payne was saying before, they're really focusing on their big profit areas, bringing cars back to the American people. So this really isn't something that we're too worried about. It was mainly just closing some of the unprofitable facilities, mainly in Asia. The next slide, I'll go a little bit more in depth. So as Payne was saying, the revenue is concentrated in North America. Even though GM does sell more cars internationally, specifically in China. And this is mainly, the revenue really isn't reflected too well in this because most of the income flows through joint ventures in Asia, and these don't actually show up as revenue, but they show up as equity income instead. So this is pretty much why this is the way it is, honestly. And then looking at the figure on the right, we can see that GM does have a stronghold in the crossover and truck market. This is going to give them a pretty big advantage, especially in America. And as they push for their electric vehicle fleets, having a majority of the truck and crossover market is going to be very important for them going down the road. Here we're going to look at some of the main financials. I'm not going to go through every single one here. We're welcome to answer questions later on if you guys have any. I'm just going to go over some of the main ones. Looking right at the PE ratio to start off, we can see that the PE is much lower than the industry average. And we can't take into account that Tesla does skew this number because their PE ratio is over 900, which is absurdly large. But even when you look just at like Toyota, for example, GM does have a much lower PE. So this is why that we think GM is undervalued, especially in the industry. PE is just a great indicator of this. And then looking at PEG for future growth, this is also another indicator that GM is undervalued in the industry. Just more signs to point toward our recommendation. And then finally, looking at return on equity, ROE, we can see that it is higher than the industry average, and it's higher than Ford and Toyota specifically. This is partially driven because ROA for GM is higher than industry average as well. But just looking right at ROE, having it better than the industry average is key for us, and it's just a great reason to look to invest in GM.
All right. One aspect that will drive growth is the development of electric vehicles, and EV is thought to be the future of automobiles. Favorable government policies such as subsidies, tax rebates, and other incentives will help boost EV production and sales, and governments around the world want to push toward a cleaner environment, which will increase the demand for zero-emission vehicles. GM has a financial commitment to EVs of $27 billion through 2025 and plans to offer 30 all-electric models at all price points and uses to eventually transition to an all-electric portfolio. GM is rapidly building a competitive advantage in batteries, software, vehicle integration, and manufacturing. And with this $27 billion investment, GM is developing a highly flexible EV platform powered by Ultium batteries. And these Ultium batteries are unique to the industry, and this is because it gives engineers the ability to optimize energy storage and layout for each vehicle design and function. This allows them to target any customer, whether it's for affordable transportation, a luxury experience, commercial vehicles, or high performance. Over time, the cost of these batteries should become significantly lower, which will boost production and improve profitability in the future. Lastly, these batteries can open a new revenue stream by reaching beyond its own fleet and offering the technology to other automakers wishing to expand their EV presence. For the 4-year sales projection, we use a weighted average of 3 different growth rates. And from analyst projections, the first is the global growth rate of 33%. The second is the US growth rate of 36%, and the third growth rate of 84%. The 30, the third growth rate is the highly optimistic estimation when considering GM's plan to sell over 1 million EVs annually by 2026. The weights were applied to each rate shown in the table. The global growth rate is thought to be the most relevant and accurate, and the optimistic plan for GM has the lowest weight. Cannibalization was found as a percentage of EV sales ranging from 20% to 40%. It starts off at 20 and goes up by 5% each year. Cannibalization is how EV sales will cut into internal combustion engine sales. So EV sales will replace some of the current revenue. We use a 4.08% profit margin, which is 80% of the firm's overall profit margin. This is because of the heavy research and development process that the expensive batteries are going to take. The EV price of $51,000 is slightly lower than the average EV sales price. This is to stay conservative, and the EV price stays consistent throughout the projection because it is unknown if inflation or the decreasing cost of batteries will have more of an effect on EV price. Now, Peyton will begin our second growth driver, GM Financial.
Thank you, Cameron. So moving on to GM Financial, as I mentioned before, so this is the arm that provides retail loan and leasing for GM car buyers. If you're going to go buy a car from a dealership and you don't want to finance through the bank, you'll finance through the dealership. This is where GM Financial comes into play. They also provide commercial loans for dealers in the form of floor plan financing, among other dealership loans as well. GM Financial is really GM's most profitable segment by far. It operates at slightly above a 19% EBIT margin. For comparison, GM North America operates at about a 9% margin, and GM International operates at actually a negative 4% margin. As we mentioned before, international it's very tough to turn profit there. GM Financial actually holds the #1 market share in the automotive financing industry at about 11%. And why we think this is a big growth driver for GM is because this industry, the automotive financing industry, is expected to grow over the next 5 years in both revenue and profitability. The revenue growth is predicted because of rising disposable income on the back of as the economy hopefully continues to recover, which leads to rising car sales. Being a cyclical industry, if you have more money, they're more likely to buy a car. So that leads to growth in revenue because if you're more likely to buy a car, you're more likely to finance that car as well through GM Financial. But then it's also expected to grow in profitability, and that is because of rising interest rates. You might think that this is counterintuitive. Interest rates actually might deter car sales if they're rising, but actually when it comes to automotive loans, consumers are much less sensitive to interest rate fluctuations as opposed to, say, buying a house, because you have a much smaller principal payment and usually shorter loan term. So if it doesn't deter potential car sales, what it does is it serves to increase, to pad GM Financial's margins on those loans. If they can charge higher interest rates, they're able to earn larger spreads and increase the profitability of that segment. So as this segment continues to grow in both revenue and profitability, that's really what we see as a big growth driver here, specifically for GM. To get to earnings projections from GM Financial, I don't want to go too into the weeds here, but we're just projecting industry revenue at industry growth rates given by Ibis World. And we assume GM Financial's market share remains the same. You know, if GM Automotive does better or worse, we can expect GM Financial market share to fluctuate also. But for these purposes, we'll keep that the same. To arrive at GM Financial total revenue, and then we take the industry profit margin. GM Financial operates at very similar margins to the rest of the industry. And as you can see, that margin is expanding over the course of the next 5 years to a little over 24% margin in 2025 to arrive at net profit numbers, an example for 2021 of $3 billion and a specific GM Financial EPS of $2.10. So that's where we get our projections for GM Financial from. And moving on to the valuation method as a whole. So we start with GM's core EPS. So this core EPS is really still the big bulk of the company because there's, their GM North America, their car sales in North America and worldwide. This makes up the bulk of it at $3.73 a share in 2021. And then we move down to incremental electric vehicle EPS. So as you can see, these numbers are very small. 4 cents in 2021. So why are we talking about it? Well, notice the word incremental. That is not the total EPS that EV sales will bring in, because EV sales will be a big part of that core number. But we project that the incremental, like what EV, as the product mix shifts towards electric vehicles, this is what we project that electric vehicles will add to that core EPS, the incremental addition, because as it becomes more profitable with battery technology, and it grows the pie slightly by attracting different car buyers. And so then we take our GM Financial EPS numbers we estimated previously to arrive at a total EPS projection in 2021 of $5.87 a share, all the way up to around $7 in 2025. As you can see, this is a pretty big jump from last year. They had a $4.36 EPS in 2020. This is really driven by a huge bump in GM Financial and also their core business, because as the economy continues to recover, GM will recover as well. And then also in the future, driven by a high electric vehicle growth rate as well. Also, on top of our baseline estimates, we did a scenario analysis projecting optimistic best case and pessimistic worst case scenarios of EPS. So our optimistic scenario takes into account that, say, electric vehicles don't take off as much as we thought. Maybe there's more weighting given to the more conservative growth rate. Okay, maybe it's more. Actually, sorry, I'm talking about optimistic. Maybe more weight is given to GM's really optimistic growth rate. Maybe that they're more profitable than we thought. Instead of a 4% margin, say it's 6 to 7%. And then say they grow their market share for GM Financial. So all these factors combine as a best case scenario, $6 in 2021. And then a pessimistic is basically all of that in reverse. EV sales don't take off. They are less profitable than they thought. They actually contract market share. And also on top of this, cannibalization becomes more of a factor. EV sales cannibalize more of internal combustion sales over the next 5 years than we originally thought. This takes us to a $5.40 pessimistic EPS in 2021. And this number stays relatively flat over the next 5 years. To get to our valuation method, I don't want to get too into the weeds here, but we did a two-stage discounted cash flow valuation for the next 4 years based on free cash flow estimations, using our profit estimations and estimates from value line for the likes of working capital, capital expenditures, and the like, and then assuming a 30% steady state growth rate in 2024 and beyond for our two-stage discounted cash flow method. All right, we also did a price to earnings method. We assumed a 10 PE baseline in 2021. This is a little below GM's current. We just want to be conservative there, below GM's current PE. Then we assumed a pessimistic scenario. Hey, maybe the market doesn't like that much, goes down to 8, or the market kind of falls back to earth. Or optimistic, say, hey, maybe GM starts to be seen as more of a growth company, 12 PE estimate. Then moving over to figure 18, the combined target price, you'll notice we placed 60% weighting on the discounted cash flow methods rather than the 40% PE method. And this is because you can make a strong argument that the market's a little volatile, a little overvalued at the moment. It's kind of become detached from fundamental analysis. So we think the discounted cash flow methods really provide the most accurate picture of the intrinsic value of GM stock. So that's why we place more weight on them. This arrives at a baseline target price, $65 a share, pessimistic $46, optimistic $83. At a current price, this is as of yesterday's market close, of a little less than $59. This provides a 1-year target return of 11.3%. So those are our valuation numbers for that, and we're more than happy to answer questions on that in the Q&A session. Now I will pass it on to Cameron.
Thank you. For risks, the less impactful risks include product recalls, political risk, supply chain disruptions, and ride-sharing growth. I'm going to focus on a couple of them. Political risk could include the increase in emission regulations or U.S.-China relations. And the supply chain in the auto industry is very complex, so disruptions in the supply chain can evaporate profits immediately. So an efficient supply chain is critical for success. The auto industry may be concerned with ride-sharing growth, such as the use of Uber or Lyft. Ride-sharing could reduce the number of cars in use for larger cities, which could affect future sales. If GM can penetrate this market through Cruise autonomous vehicle services, this could end up being a positive For the 2020 quarter four earnings call, CEO Maribara announced that GM plans to launch its own ride-sharing service and they already have developed their own app, which employees are already using. For more impactful risks, there's building brand loyalty, recessions, and EV cannibalization. The automotive competition is intense, so brand loyalty is critical in the battle for market share and returning customers. So this will be a component for GM to work toward to build future success. For recessions are generally unpredictable or very difficult to predict. The recession is a risk most industries are severely affected by. But being considered a consumer cyclical stock in periods of economic expansion, consumers are looking to purchase new cars, and automakers like GM experience strong growth. When the economy is in a recession, the opposite is true. So the question is, will there be a recession soon? We would have to lean toward no because of the continuing stimulus. While this may lead to higher inflation and rates in 4 to 5 years, it does not appear there's a recession approaching for now. EV cannibalization is the effect of EV sales will have on ICE sales. As EV sales increase, there will most likely be a decrease in the total ICE sales. In 2020, EVs accounted for 2.5% of all new car sales. And by 2030, EVs are expected to make up 32% of that new car market. Instead of EV adding additional revenue for GM, it is very possible it could simply replace existing revenue. But GM could position itself as an early innovator in EV market and scoop up early market share. Now Jack will continue with how GM fits into the Spellman fund portfolio.
Thanks, Kevin. So here's our correlation matrix of GM. It's pretty hard to see, but basically GM is highly correlated to financial and tech stocks, and they're pretty low correlated to defensive companies. So you can kind of see like JP Morgan, Prudential, bookings. Those are pretty highly correlated. And this pretty much makes sense because GM Financial does make up roughly 15% of GM. So 15% of GM is a finance company, which is why it's pretty highly correlated. And then looking at the other end on lower correlated, these defensive stocks are meant to withstand recessions. Johnson & Johnson, Procter & Gamble, CVS, they're meant to do well even in times of recession. People aren't going to be buying cars during a time of recession, but they are going to be going to the pharmacy and getting those sort of items. So this is kind of why they're low correlated. Not only that, but we believe that GM adds needed consumer cyclical exposure. Not only tech, but communication sectors are very overweight right now, especially in the fund. This is why it is crucial that we add cyclical exposure, consumer cyclical. This is just a main reason why we believe it's important to add this. Looking specifically at the portfolio fit, the optimal GM weight would be 2.76%. This would mean roughly $11,500 of GM into the portfolio. Google and Facebook are overweight, in the fund, especially Google. This is why we're going to be looking to sell off Google. Payne will go more in depth on that on the next slide.
All right, finally, our recommendation. So our recommendation here is a strong buy, and I'll go into the reasoning in the next slide here. But our recommendation for the specific transaction would be to sell 5 shares of Google. As Jack mentioned, the communication sector is pretty overweight in the portfolio. Consumer cyclical, very underweight. And there's a pretty high correlation between the two, Google and GM, over a 0.5 correlation there. So we recommend selling 5 shares of Google to free up about $11,700, and then buying 200 shares of GM, that's as of last market close, to also buy about $11,700 of GM. Now, just to wrap things up, why do we believe GM's a strong buy? Well, it's an established, well-run company. It appears to be much more profitable in the industry, given with higher ROE, ROA, and then it's relatively undervalued to the industry, given its low PE and its PEG. And we think GM's really in a great spot to take advantage of the EV boom. Everyone's looking at Tesla. Tesla's very expensive, and GM might provide a better car than Tesla does in the near future. They have the economies of scale with their vast production capacity, and they have the economies of scope with their battery capability to bring a bunch of different affordable priced EVs to the market. So obviously, this is a big risk for GM if it doesn't pan out. Everything we talk about here may be down the toilet, but so they need to be able to build good EV cars in order to capitalize on this industry. And so just to wrap it up, we believe that we need to increase the exposure to consumer cyclical, decrease communications exposure. And for GM specifically, we have a target price of $65 a share, indicating 11% return. So now we thank you for listening to our presentation. And now we'd like to open it up for questions.
All right, so we have about 15 minutes for questions. If anyone would like to get us started.
Can I jump in with a question on cannibalization? And I'm trying to figure out how how that rate is anything other than 100%. If I'm a GM car buyer and I go buy, I have an option of, gasoline engine, electric vehicle. I buy the electric vehicle. That's a 100% loss. You lost the gas sale in favor of that. Or is this a market share where for every buyer, one of them was a Chevy truck buyer, one of them was a Ford truck buyer, one of them, or can you elaborate on that cannibalization rate?
Yeah. From the sources that we've read, they look at 2021 being between around 10 to 15%. It's very possible it could grow a lot faster. But we found a trend that was increasing by around 5% each year. And I think after the batteries become more produced and, flowing better, then it could eventually get to 100%. And especially if EV credits or tax credits come into play, most people will end up buying EVs, and we hope the GM could be the main player for that.
Yeah, I'd like to add too that an electric vehicle for GM might attract a completely new car buyer. We're seeing consumer trends where, especially on the back of COVID-19, they don't want to take public transportation. They're moving out of the city. And these people, too, might be more inclined to buy an electric vehicle car where they didn't have one before. So you're right in the sense that 10 to 15 years from now, it's probably 100% cannibalization. But our point here is that they could be a very early mover in this industry. And also, you brought up to expand market share, to continue to build that brand and take market share from other companies that might be lagging behind them in this new technology. So I hope that answers your question.
Yeah, I think so. Thank you. And then I'll let somebody else ask. But the other question I have, I guess, would be when we look at Toyota and talking about a higher PE ratio, it seems as though people are willing to pay a higher price for Toyota and for their earnings than GM and their earnings. Does the market have it wrong, or is there a difference that you can see between GM and Toyota, whether it's growth rate, consistency of earnings? Is it just an easier to understand balance sheet because they're not unwinding operations all over the world, or why does the market believe that Toyota's earnings are worth more than GM's earnings to us? And I won't ask about Tesla because I agree with your assessment on that valuation. But
yeah, to your point, I think Toyota does kind of have a more consistent earning stream. As you saw, they actually had a higher profit margin. And some of that actually comes from the fact that they have a much lower percentage of their U.S. workers are unionized. Half of GM workers are unionized, whereas Toyota, I don't believe they have any unionized workers in the United States because most of their plants are in more southern states where unions are less common. So that could be a thing too. So Toyota is more profitable. And I think there's certain investor, I guess, hesitancy coming out of 2009. GM went bankrupt, came back into IPO'd. The U.S. government bought a lot of that. The U.S. government no longer has. So I think there's a lot of probably hesitancy from that sense that when people think of a good car, they tend to think of Toyota because of what they did in the 90s with their totally disrupting the industry. When actually what we see now, last year, for the first year since I believe the 90s, GM actually had the highest quality and safety ratings of any other car. So that might be a reason for that. But other than that, we do believe the market has it wrong because we're pricing them much higher than their current price. So I hope that answers that.
That was good. Thank you.
Does anyone else have any questions?
Yeah, I can jump in here with a question. If you could go to the slide that talks about GM Financial and their profit margin growth, please. So when you came up with the increase in profit margins, I know you alluded to the fact that you anticipate interest rates to rise and therefore they should be able to create a higher margin on their loan. Did you use an actual estimate of where you think interest rates will go and what their profit margin would be, or is this just like a flat-lying growth rate on that margin?
Yeah, so we did not impute interest rates and try to calculate profit margin based on that. These profit margin numbers are actually directly from IBIS World. Their profitability growth projections. So that's where those projections come from.
Okay, and are those GM specific or industry? Is that industry profit margin you're quoting there?
That is industry profit margin. So actually, GM Financial in the past has been slightly more profitable, but we're talking like less than 1% more profitable. The industry they operate pretty well in line with the industry. So we just took those numbers as an industry profit margin to be a little more conservative, to not assume that GM's going to continue to be much more profitable than the industry.
Okay, that makes sense. Thank you.
Do we have any others?
Hey guys, I can see that Eddie prepped you guys well, so congrats to him. That's about the only compliment I will give Eddie. And to answer one of Tyler's questions, there will be at least 99.99% cannibalization, because until they can build a battery that can power my F-250, it's not going to make the turn. But quickly to you guys, nice job. I wanted to go back to the slide where you talked about the EV, your EV numbers, breaking it out. And the question I'm going to ask is kind of a conversation that we had in some of our prep numbers. I was curious how you guys ended up with the 51,000 for the average projected EV price, how you guys came up with that weighted average.
Yeah, the average EV price is around 56,000, and I think there's always going to be a more affordable vehicle. I think the Bolt is around 36,600 right now, so it's much lower than that average. But there's going to be those cars like the Hummer that's going to be 100,000. The sport cars they may come out with, SUVs and other trucks that might push that price up higher. There's luxury cars that typically will push up the price a little bit. But yeah, there are going to be more affordable. They're going to try to hit every consumer with different price points into cars.
Okay, so you said that the average was 57,000 is kind of what you found in your research.
56,000, yeah, was the average.
Okay. All right, so you just went a little conservative on the 51.
Mm-hmm.
Okay. I was just curious, given for those the rest on the call, we're just having conversations about how to best benchmark that, given the infancy of the industry, and there's just fewer options, and obviously it's similar to in this case where you have an outlier being the Hummer, and even some of the Tesla cars that are over 100,000 that not everyone, unless you're Tyler, is going to be able to afford. So no, I appreciate the insight on that, guys.
Great job, guys.
Can I ask about the?
Go ahead,
I was
Eddie.
gonna say-
Sorry, Tyler.
I was just going to
throw
ask
one
about
thing
the
in there?
dividend. So I was going to ask about the dividend, and then Eddie, if you want to jump in with something before that, go for it.
You know what? Before we switch to the dividend, I was just going to stay on the 51K price. First off, great job, guys. I don't have many questions because I had already asked a whole ton of them. But if you get back to that estimate of 56,000 for the EV price, do you know what the current average price for combustible engines is today? I don't know. I was just curious if you know.
I'm not sure. I'm not sure.
I was just curious in general if that EV price is below or above it. I mean, I guess there's a wide range, probably of a wider range of combustible on the high end and low end than there are with EVs. But I was just curious.
Hey Eddie, on a comparable basis, I know I saw some stat, I don't know, a year or two ago that kind of blew me away, that the average truck coming off a lot in the States was about 50 grand. So if you consider the majority of the vehicles sold are trucks or SUVs, I think that number is probably moving up closer to that 50,000, unfortunately. Pains me as a value investor.
Great job, guys. Thank you.
Thank you. Tyler, would you like to ask your question?
Yeah. So this is a company that had, reinstated post their emergence from bankruptcy, reinstated the dividend, had been paying a dividend, suspended it. And then the last couple of quarters, they've posted some pretty decent earnings numbers. Is there any discussion, within the research that you've done about reinstating that dividend? Or are we expecting to get a return here in the fourth quarter, or when does that start back up again?
Yeah, great question. So as you can see, so our target return does not involve dividends in it. That is purely what we believe, price appreciation. But yeah, to your point, so they suspended in April 2020. Prior to that, they were paying consistently $1.52 per share since 2016. And in a recent earnings call, CEO Mary Barra said that they do foresee reinstating that dividend within, I believe she said, possibly within 2021, or if not, like within the next year. That she didn't give an exact number, but she said at a level that helps them maintain their various commitments and to leverage their growth prospects while also rewarding investors. So to your point, yes, we do foresee it in the near future, but we don't want to assume that, so we didn't figure that into our calculations.
Okay. And then was there any talk about Nikola? I think it was GM had talked about making a significant investment there, and then there was some questions about the Nikola electric engines. Is that part of the EV vehicle growth plan, or have they kind of scrapped the relationship there altogether?
Yeah. Do you want to take this, Cameron, or do you want me to?
You can.
Okay. Yeah, to your point, I honestly, I've been reading the past earnings calls and their annual report. I don't think the word Nikola was in there at all. So that might have been scrapped, or that might still be speculation. But so to your, I don't believe so, but I'm not aware of that.
Okay. Average light vehicle in the United States, 40,857, according to Kelley Blue Book. All right, I'm done.
Adam, can you hear me?
Yeah.
Yeah, okay. Do we still have time for another question?
Yeah, we can have one more question.
All right. So my question is sort of a higher level one. So this is a car company that makes I guess has the highest profit margin on its finance business. So why? So what does it have, or how does it protect that finance business from other financial firms from invading on its territory? And does it have the potential to expand that to other areas? Outside sort of GM's, I'm sure they do sort of used car stuff too, I would guess. They've got credit cards, I know. But how do they sort of expand that further? So sort of I wanted the threats in terms of the market, both sort of threats from outside and then ability to sort of expand that portion of the business.
Yeah, very good question. I think obviously it's built on the back of their vehicles. So if they're not selling vehicles, it's going to be very tough for them. The GM Financial is going to struggle as well. So that's a good point, that maybe growing beyond their current offerings would be beneficial to them. At the same time, I don't think they want to get too far away and start straying into territories that they're not familiar with, that aren't based off that core competency of being able to bring a good car and to the American people. So yeah, to that point, I don't know. I know they've explored with their OnStar segment, vehicle insurance, which with autonomous vehicles and ride sharing, they'll have more data, which they'll be able to price claims better as well, or price policies better. So I know that they're kind of expanding to that sense. So it's not quite GM Financial, but it's similar.
So how does the threat of reducing their footprint internationally in terms of sales affect the finance arm? Were they doing no finance in China and in Australia and Europe, or were they doing a good bit of it and now they're going to lose that business too?
Yeah. Well, I mean, in fact, I mean, you saw I will go back to the GM Financial growth rate. So GM Financial it's been falling at a similar rate to the rest of its revenue. So I think it already kind of has. I don't think that's a future thing as much too, and they have higher quality, like better credit scores, portfolios in the United States than they were dealing with internationally. So if anything, it kind of bolsters it lessens the credit risk within GM Financial as well.
Okay, thanks.
All right.
All right. Well, we should probably wrap up this first presentation then. But great job, guys.
Hey, Adam, could I just jump in with one quick thing that I thought of? The guy's still there. Hey, I just saw this. Your suggestion about Google. The one thing that the board should be considering, and you guys, I apologize for not bringing this to you guys earlier. I didn't think of it till now, but you guys had mentioned like the market share, I guess the weight of Google within the S&P 500 at 2%. You got to remember there's 2 share classes, so it actually is like closer to 5% in the S&P 500. Not that should change anything, but I thought, as the board thinks about any changes that we might make, we decided to do that based on it, being presented as under, at a certain level within the S&P, it's actually double that because you have 2 share classes. So essentially, Google as a company is about 5% of the S&P 500. So it's maybe not as overweight as it was projected. So I just caught that now in your guys' presentation. Like I said, I'm sorry I didn't catch that earlier, but something, again, life lesson to think about. Shame on me. That's all I got.
Okay. Well, we thank you for your time, and we just thank you.
Yeah, thank you.
Thank you, everyone.
Should we leave now?
You can stick around if you want, or it's up to you. But we'll move on to our next presentation, Chevron. So if someone wants to share their PowerPoint, and Chevron Group can start whenever you're ready.
All right. Let me see. It's not. 1 second. I don't know if this is the right one. This one looks right. All right, everyone. We are going to be pitching Chevron as a stock today. My name is Adam McCabe.
I'm Dhruv Patel.
And I'm Patrick McClune.
So we are recommending a hold with Chevron. But some of the reasons why Chevron interested us is because we believe that the Chevron stock would reach their price that they were at pre-pandemic levels, and that they're expanding into fields other than oil. And Chevron even said that 2021 would be the year to recover for them. Our target price got a little messed up with our EPS estimates, and especially because of how low their EPS was in 2020, and their current price is at $110. Some of the things that Chevron does, they discover and explore new areas that they can harvest oil, and then they can create and manufacture refined products such as gasoline, diesel, natural gas, marine fuel, and aviation fuels. Some of their challenges that Chevron faces is that people are constantly pushing for using electricity over gasoline products. And then some of the opportunities for Chevron is that travel demand will be increasing soon as more vaccinations get pushed out, and then people will want to be traveling more for work and for recreation. And that leads to one of our key drivers, which is the expected increase in demand for oil. And then our other driver is the increasing demand in the cruise line industry. Some of the risks that Chevron faces will be like new regulations that are implemented every year, alternative fuel industries such as like electric car companies, and climate change impacts. There's a finite supply of oil in the world, however, that shouldn't impact Chevron short term. And the pandemic was a huge risk for Chevron, but they have since recovered from that. So as you can see, as I mentioned before, their stock price was at $110 today, which we believe is very overvalued for where they're at now. It's not showing, it doesn't show the graph from the from March, but when the pandemic hit, their stock price went from around $120 to like 55, I believe. And then as you can see by our key statistics, that 2020 was a really rough year for Chevron, as all their ratios shown have gone to the negatives with a negative EPS of almost 3. And now I will pass it over to Drew.
Yeah, so we're just gonna give you guys a overview of the business, a breakdown of their revenue, go over their financials. Gonna cover the growth drivers that we believe are important, like oil demand and travel demand. Gonna give you an explanation of the valuation and the risks, and we're gonna talk a little bit about how this stock would fit into the Spellman fund, and wrap it up with our recommendations. Right, so Chevron is an energy corporation that produces upstream and downstream products in the oil and gas industry. And they also operate in power generation, chemical manufacturing, sales, refining, marketing oil products, and hydrocarbon exploration. What upstream products is just products related to drilling, exploring, and recovering crude oil and natural gas. And downstream products are basically just refining, marketing, and logistic-based services. Here I have a graph of the 5-year revenue stream by segments. As you can see, downstream products kind of bring in the most revenue usually for Chevron. As you can see, that's a regular pattern for them over the last 5 to 10 years. And here you can see that it's usually just downstream followed by upstream products, and then their other business endeavors bring in a good amount of money as well. Like Chevron's also the world's largest producer of geothermal energy, which fits into the other category. Now Adam's going to talk a little bit about their financials.
Yeah, so for their financials, when compared to other companies in the industry, Exxon usually has a trend of having like really high PE ratios, as well as like the industry averages that I could find, that their PE averages are usually pretty high. And Chevron's was pretty high during 2019, but you could also say that Exxon is just overvalued with the PE ratio. Other than that, they're usually pretty standard. Their net profit margin is kind of in the gutter right now, and especially in the past 12 months. But as I said before, 2021 is supposed to be turning that around. And then their debt to equity also is fairly high when you compare it to the industry average. However, it is very similar to Exxon, who is the largest oil-based company in the United States. And now Patrick will take it over with the drivers.
Thank you, Adam. So for our first driver, we chose overall oil demand and production for Chevron because of the massive loss of limited production and decreased demand of 2020 with the pandemic. We figured this would be a great way for Chevron to jump back into that oil demand as it increases. There was a steep decline in production and demand, and kind of a slow recovery so far through 2020 and 2021. So we expect this place to be a good growth opportunity for Chevron to tap into. As you can see, there were 37 billion barrels produced in the demand for 2019. That was cut by 3 billion to 34 billion in 2020. And what it looks like now is, so that was an 8 million barrels per day decrease. And right now in 2021, there's an estimated 70% recovery of about 5.5 million barrels per day being produced. So about 70% back to those 2019 numbers. And 2022 will climb up and eclipse the 2019 numbers. So again, still a slow slow increase over the next few years, but hitting 2022 and getting back to those numbers. And we think, as travel and other sectors as well increase their demand, this will continue to rise. And as you can see here, this is the 90 on 2020, the 95.89 was the millions of barrels produced per day. And then we times that by the market share of Chevron of 4%, which gave us the 3.8 million barrels produced per day, which would give us like the 1.39 billion produced by Chevron per year. And if you take a look at the 2022 numbers, you want to go back to that one? Thank you. If you take a look at the projected demand for 2022, that is similar to the demand of 2019. 2019 was 102 barrels per day. So getting around that same area back in 2022, and then continuing to grow forward with oil demand. As you can see, we're going to increase 2021 here, 2022 get back, and then continue to grow. And then we'll take a look at our next driver. We chose to specifically of the travel industry, look at the cruise ship industry that was completely crushed by the pandemic. There were only 200 sailings in 2020. As you can see here, there were 270 ships active in 2019, which do almost weekly, bi-weekly trips. So a massive number of trips that was just cut over the past year. With growth expected as more vaccines roll out and people are back to traveling and more comfortable with traveling, there will be 270 ships this summer starting to be activated by this cruise ship industry. As you can see here, 150 tons is used per day by a cruise ship, which comes out to 30 to 50 miles per gallon. So a ton of fuel is used here, and we felt this was an area that Chevron could fill into as travel starts to increase again. And in 2022, all new cruise ships that will be made will be powered by natural gas, which is another huge revenue stream, one of Chevron's largest core business. And so we just figured this would be great for Chevron as well. And as you take a look here, we'll look at the money spent, the 1.4 billion spent on fuel by the cruise ship industry. We're going to multiply that by Chevron's market share here, and that gives us our revenues of cruise ship for Chevron. And as you can see, a massive cut. Numbers, again, similar in 2022 were similar to those of 2019. So as you can see, a massive cut, almost half of the revenue was lost in this industry from Chevron by the cruise ship industry, but then continuous growth in the future estimated demand as, again, travel picks back up. And now I will pass it off to Adam to talk more about valuation.
Thank you. So yeah, as you can see by the top numbers is the amount of EPS from the increasing demand of oil. So we expected 2021 to have a very big impact, especially compared to 2020. It'll definitely generate a lot of revenue for Chevron. As for the cruise ship demand, we were expecting it to be a bigger portion of Chevron's total EPS. However, we do think that this is also attributable to like other travel demand options, such as like flying and stuff like that, or even just using, your vehicles for traveling other places to other states and stuff like that. But yeah, it wasn't as big of a impact as we had planned it out to be. And then we couldn't really generate the 2021 numbers because we were going off of negative EPS numbers from 2020, but we will see a pretty big spike in 2022 for the increasing oil demand. However, then it'll slowly start to stagnate because I believe, as Patrick said, it only goes up so much each year from then on. And now I will pass it over to Dhruv to continue the valuation.
Actually, I'm going to take this one, Adam.
Sorry about that.
No worries. What we're going to look at is the actual EPS projections through 2024. As you can see here, we have our three scenarios with our baseline, optimistic and pessimistic. To get our optimistic and pessimistic, for optimistic, we did a 4% increase, and for pessimistic, we did an 8% decrease. And then obviously, as you can see here, we have our 24 EPS projections. And now we'll take a look at our second valuation. We did the discounted cash flows for our second valuation. As you can see, we are projecting increases across all areas, hopefully large jumps from 2020 into 2021 for net profits, moving forward with continuous strong growth through 2022, 2023, and 2024. And now I'll pass it off to Drew to talk more in depth about the three scenarios.
Thank you, Patrick. So yeah, as Patrick said here, we used a 4% increase for the optimistic approach and an 8% decrease for the pessimistic approach. The basis for our optimistic approach was if the oil demand exceeds expectations this year and moving on. And then the basis for our pessimistic approach was the oil or gas demand never getting back to pre-COVID levels. And after our calculations, the target price, our baseline was 79.66. And our optimistic approach gave us a target price of 82.72, and the pessimistic one gave us a baseline or target price of 73.47. Now moving on to the risks. First off, the risk that has a low probability but very high level of impact is the finite supply of fossil fuels. Then the transition to alternative fuel industry is happening faster than experts predict is also a risk. As of right now, most experts are predicting a full transition to renewable energy around 2050. So there's a lot of time between now and then. And there are also a lot of regions around the world still struggling with the pandemic, which can affect Chevron. And then new regulations are passed regularly for this industry. So that is something to look out for. And finally, climate change is also a huge factor. There can be very serious impacts on the industry if things get worse for the climate, because it can really damage the industry's long-term social acceptability and profitability. I'm going to hand it off to Adam now. He'll talk a little bit more about the portfolio fit.
Thank you. So here's our correlation matrix with the other stocks in the Spellman fund. We did only have one stock that had a negative correlation, that being the Next Era Energy. And then it is kind of following a trend of like the ones that Chevron had poor correlations with would be usually ones that other stocks would also have poor correlations with. So Emerson Electric Company was the highest correlation, and that could be attributable to the fact that it is also an industrial company. Next Era Energy was the lowest, which was kind of surprising because it's also an energy, but it is an electrical energy company. Some of the most correlated sectors were the financial services, industrials, travel, and communication services. And then especially with the financial services, because we had JP Morgan and the PRU, which is, I believe, the Prudential Financial, I can't remember exactly. And then technology was the most prevalent for the low correlation, with 3 of the companies of the lowest 5 were technology companies. And then it comes down to, we would recommend a sell of Apple based on the correlation matrix. We think that the number that was pitched in our class, the sale of 86 stock or 86 shares, does kind of line up with ours, because we'd like to match the amount that we'd like to buy of Chevron if we were to buy Chevron. And now I will pass it to Patrick to conclude this.
Thank you, Adam. So for our overall summary here, what we believe is with that steep decline of oil demand and production, with limitations due to the pandemic and a kind of a slow recovery through this year, we believe with oil demand returning to full production soon, this will be a great opportunity to buy into Chevron, as well as travel demand will continue to increase as vaccinations roll out and more travel from cruise ships, airlines, and domestic travel within the United States continues to increase. We'll see an increased demand there as well. And then Chevron, with its large infrastructure and strong company base, we have the ability to plan for future energy programs while still producing oil and still on that foundation of oil and natural gas, and possibly reaching into those new energy, renewable energy sources as well. And Chevron has done well since February. When we first looked at Chevron as a stock, it was around $85. And since then, it has increased to $110, close to pre-pandemic trading. We do believe this is slightly overvalued since oil production and a lot of their other productions have yet to return to full capacity, yet the stock has reached closer to pre-pandemic numbers. But that is why, again, we are recommending a hold. We do believe it is slightly overvalued. Our target price was around 79, so we were hoping, if it drops down to $75, that's where we would buy in for Chevron. So thank you very much for being here and listening to our presentation on Chevron. Thank you.
All right, nice job. So we have a little under 20 minutes for questions.
I'll start. All the talk about oil demand and those types of things was good, but I didn't hear anything about the price of oil. It seems to be clearly a driver of the profitability of this business. If I look at the massive losses they posted in 2020, it's consistent with oil. I don't know if you remember this. Oil was negative at one point, but it's consistent with oil prices below, call it $25 or $20 a share or a barrel, excuse me. And you look at a previous quarter back in 2016, they also lost some money. At that time, oil was about $27 a barrel. So it seems like the company has a little bit of trouble under the current cost structure making money when oil is below, let's say, $30 or $35 a barrel. Currently at 65. What is your outlook for the price of oil? Is it going to be consistent? Are we going to see it continue to rise? Are we going to, what's your long-term view? And was that part of the analysis when you talk about their earnings per share? Or were there some assumptions made about the price of oil when you made your EPS projections?
We did do a few assumptions. Yeah, we should have added it to this. Because we did assume that oil would reach, I believe, we found a projection that it would be around $58 because I believe that's around what it's at now. It depends on the barrel of oil too. And then we found some sources that are at the bottom of that slide, but it shows that that the price of oil should increase around 50 cents a year based on the sources that we found.
So generally speaking, we're talking about oil demand as the driver of growth as opposed to the price per barrel. There's some consistency expected in your projections? Sounds like?
Yeah.
Okay. Great, thank you.
I guess I'll jump in if no one else has questions. First off, I just want to start by saying kudos to you guys to come in and basically put a hold on a stock using the data to make a decision, so to speak. That's very impressive because what we've talked about in the past, or we've seen in the past, is where people will come in and put a buy rating on a stock and then try to make the numbers work. So I think you guys need to be commended on that, first and foremost. And then the second piece that I really liked, this is more of a qualitative thing, is that after you did the analysis on the cruise demand, you saw that it wasn't as big of an impact as you thought coming in, and you made that comment, and I think that's awesome as well. Being honest with your assessments after you kind of make that demand, or I guess make the finish up on the analysis. So again, kudos for those two main points. Thanks, Tyler, for asking about the price of oil, because that was one of the questions that I had. I was kind of curious. One of the questions I initially was going to ask until he brought that up was, why do you think the price went from 85 to 110 over the course of the semester? Feel free to answer that quickly if you want to, but I think kind of you probably touched on it with the price of oil spiking and the impact that does have on energy stocks in general. But I kind of want to dig into a couple of your slides, slide 13 and 14 quick. I was curious what is the other EPS? Because that kind of jumped out to me. 43%, 25%, 21%. I was just curious what that other category is, and how big of an impact is that on the overall EPS of Chevron?
So I believe the other, because we did it all through Excel with the help of Stivers, because he kind of laid it out for us on how to calculate it out. So the other was just kind of like there's just the leftover of those two EPS drivers. But I did notice throughout our research kind of later on was like how big natural gas was for their income. Like natural gas is like one of their biggest things, but we had already been going into like the oil barrels and the cruise ships. So
understand. And then on the next page, on page 14. So I was curious if you had it, like what your thought process was, methodology, so to speak. So you take the 2020 EPS, and then you have your various baseline, optimistic, pessimistic adjustments that you make into 2021. And then you kind of use that as your starting point. So you make your one-time adjustment based on, here's my baseline, here's what I think could be a great outcome, and then here's what I think could be a less than great outcome. And then it appears to me, if I'm reading this correctly, from 2021 moving on, you then use the same growth rates. Maybe it's slightly different. Okay, sorry. Well, it's very similar. Okay, could be due to pennies, but it looks like you kind of use the same essential growth rate for each one of those various opportunity sets. When I would think, if you had a pessimistic view, you would say, well, I think, next year, 2022's earnings are going to be a slightly lower growth rate than my optimistic. Let's say I think the optimistic is going to be 21.4, the baseline is going to be 18, and the pessimistic is going to be 16, and then you go into your 223, and then you're always going to have like a divergence between those three outcomes, but you've kept it the same kind of moving out, where again, you've only made that one-time adjustment. So I was curious what the thought process was behind that.
Yeah, I mean, that is a good idea. I don't know, the thought process, we kind of just based it off of our baseline EPS, and the baseline EPS was really hard for us to predict, because I changed the numbers like 5 different times, because I could just like never come up with something, because their EPS, especially in the oil industry too, I found is just like, they go crazy like every year, where it's like one year they're at like 18, and then one year they're at like -5. And so I had no idea how to predict what the oil was. So I guess I kind of just wanted it to be kind of, I don't know the word, but like just kind of the same throughout each year, just assuming the same. I don't know.
Okay. Well, I appreciate, again, the fact that you used the term I didn't know because of the volatility.
Yeah.
So, there's a lot of times in life you're going to find out that you just have no idea. So sometimes you just have to, do the best option you can come up with and run with it.
Yeah.
So I don't argue with that idea, but yeah. Okay. I
Thank
think
you.
that's the two main things that I had. If anybody else wants to jump in.
I would agree, Casey. I've made a career out of not having a clue and being able to admit it. So that's good. So I'm curious. I read, and this, when we look at the global themes, and we talk about the environment, we talk about climate change, and we talk about companies taking action to sort of change their own carbon footprints and things like that. I'm going to misquote this, but I thought I read that British Petroleum, BP, will not be a petroleum company by 2040 or 2050, where they would be completely carbon neutral. And in fact, all of the revenue sources would shift to clean, renewable energies. You talked a little bit about some changes coming in 2021 and this being a shifting year for Chevron. But is there any talk about just completely stepping away from oil and natural gas? Because you kind of mentioned that 2050 was a key year, but did they commit to that change, or did they just anticipate that by 2050 all cars will be electric? Or do we think that gasoline and the petroleum business as a whole is just dead by 2050? And we're hoping that this company, if we're going to make an investment today, we're hoping that this company is making changes to be a renewable, clean energy company by the time that happens. And what was give me a little longer term synopsis of where you think this company's heading and what shifts or what changes they're making.
I think. Oh, sorry. Go right ahead.
You can go, Patrick.
I was just going to say, to start, through our research, what we had seen is that Chevron had kind of just begun focusing in on the renewables. They have, started this new partnership with Algonquin Energy to use their old oil fields to produce these solar and wind turbines. So, excuse me. So they have started, but this is, I believe, 2021 is year one of their 5-year current plan of renewable energies. So there is a slight push in that direction as of now, but it's definitely like the early age, and there's definitely been no full-time commitment, as BP has said, that we have found. But there is a commitment to finding that renewable energy, and it's just gonna, in the starting years of now, is kind of what we had seen. If you have anything more to add, Adam.
Yeah, I was just going to say that, because when looking at their annual reports, that they spent like $2 billion in 2020 on environmental process. It said that had to do costs associated with and buying new companies with because I know that they're looking into a renewable natural gas a company that they've been working with, or that they purchased, I believe. And then I know Drew found a stat too, I believe, that was the prediction for when the United States will be completely free of non-renewable resources too. I think it was 2050, I believe, or something like that, like what you mentioned earlier.
Although Casey's got his boat, and I'm guessing he has no plans to retrofit that with a solar engine or something. So. All right. Well, thanks, guys. Those are good answers. Good job.
Thank you.
Thank you.
All right, I'll jump back in. First and foremost, I have a 30 horsepower Johnson, so this is not guzzling a lot of gas. I'll give you guys something to read over summer break. So basically, the must-read energy paper that gets published every year. I just Google it, so you can find it. So if you write this down, if you got any interest, it's always very, very thorough, and they talk about a number of different things, including a lot of the timelines that are built into, I guess, your stock pitch. It's the J.P. Morgan private bank. Right now, it'd be the 2021 annual energy paper. You can just Google that and you'll find it. So again, J.P. Morgan private bank, and it's it's very well done. It's 44 pages, but it's actually a fairly quick read because there's a lot of graphs and whatnot. But your timing is good. And in fact, I wish it would have came out obviously earlier in your semester where you could use this as a pretty good resource. But it definitely goes through a lot of the probably supplements a lot of the things that you just discussed about essentially. Everyone wants green to happen much faster than, unfortunately, given the science and technology as it stands now, it's going to get drawn out a lot longer. And I think I made a reference the previous presentation about my F-250, and I think that's the biggest thing is you have guys that have, and gals that have large trucks that use it for actual pulling and need that diesel power, so to speak, and until the battery power is there to actually do like a semi, for example, or in the case of the cruise ships that you guys mentioned, it's just going to take a lot longer than what people are hoping for, so that Chevron and the likes will have a much longer tail than what a lot of people are probably predicting. So I would definitely suggest reading that, like I said, in your leisure, because it is really interesting stuff, and it's very research fact driven. So very, coming from J.P. Morgan, they're not going to try to put a little over your eyes, so to speak. So definitely give that consideration.
Yeah, absolutely. Thank you. There's definitely something that we'll have to check out in the future here. Thank you.
That is kind of fitting too, because JP Morgan was like one of our most correlated stocks. So.
We have a few more minutes if anyone else has questions.
Do you guys mind just jump into the slide that you had, the pricing? You had like your EPS pricing model, and then you had the free cash stuff. Since we have a couple minutes. All right. So, yep, okay. Perfect. Okay, so the price is around 110 today. I think I was looking at the close. Yeah, so it was up 92 cents. So 110 today is what it closed at. So it's kind of right in line with your 21 estimate. And then you have the figure 12. You have a combined target rate. So one of the things that I've mentioned to other groups is it appears like your EPS estimates are in line with what the market's telling you today. So that's got to make you feel pretty good that the analysis that you guys did is pretty spot on, right? Because it's essentially, if it's the efficient market, it's kind of on to what you guys did. So that's got to make you feel comfortable in your analysis. So the area that's kind of pulling you in the opposite direction, in this case, it's pulling you the price down, where in some cases we see it where it actually jacks the price up, is in your free cash flow analysis. So one of the things, and I don't know how I'm supposed to be reading this, but your price figures, based on that analysis, what was like the average price that you guys were coming up with? Your DCF methods. You guys know offhand? Because what I'm trying to do is back into like what that price was giving you, and then the weighted average based on figure 12. So obviously it's something much less than the 110 that you guys figured out with the PE ratio.
Yeah, I don't know if I have it offhand.
Do you know offhand what you guys used for the weighted average for figure 12? Like how much weight you put on the PE method versus your DCF method?
Yeah, we did 50-50, but I can't remember how we came up with that conclusion.
Okay. Yeah, that was one of the questions I was going to ask too, is how, I always like to know like the thought process of how people come up with different ideas.
Yeah.
Just because it's interesting. But I guess my main point with, like 1 minute left is again, going back to the earlier comment, when you do analysis and it seems to line up with what the market is telling you, and then you do a different analysis and it takes you way, let's say out of bounds, so to speak. You didn't run statistical analysis like Dr. Brooks would have had you done. But if you're, let's say, 1 or 2 standard deviations outside of kind of the market-driven band, that should always make you kind of take a step back and kind of question, okay, are my assumptions realistic? And, am I missing something? And again, this could be on the high side or it could be on the low side, but this is more like a lifetime lesson thing as you're doing analysis in the future for wherever you guys end up in company. And you're doing something similar. So always kind of keep that in your back of your mind. If you get something that's way out of left field or right field, take a step back and maybe reevaluate your inputs and your outputs, I guess, is making sure that it's realistic.
Yeah. Thank you.
Not to say that it's wrong, because you could be spot on.
No, I know what you mean.
All right, good job, guys.
Thank you.
Thank you.
All right. Any final questions for the group? All right. Well, we can go ahead and wrap up that presentation then. Good job, guys.
Awesome. Thank you. Thank you so much for being here for us and the rest of the groups as well. Thank you.
Yep.
Means a lot.
Thank you, everyone.
Was that cracking a beer celebration right after?
Wasn't sure where that was coming from.
Yeah, I was gonna say.
That was me. Sorry.
Nice.
That's a soda as far as I know.
Yeah, unfortunately, I'm still in the office and I didn't bring any in with me, but that'll come soon enough.
Yeah. It's okay to drink in the office once in a while.
So our last group will present on Costco. So whenever you guys are ready, you can introduce yourselves and pull up your PowerPoint.
You're on mute, sir.
Sorry. Hello, everyone. Do you want us to share our presentation in the group like you said yesterday?
Yeah, share the actual PowerPoint file to where we can click back and forth on the slides.
I will. Yeah, I'll upload it here in. Or actually, it's not letting me do that.
So if you click on the share content, rather than sharing the window or the desktop, you can share the PowerPoint. Browse for your PowerPoint file.
Oh, okay. Okay.
Yeah, and just share it that way.
Oh, that might be the wrong one. Here. See if this is one here. It
Looks good.
Yep. This is the one. Or actually, yep. This is the one. All right.
All right, whenever you're ready, you can go ahead and start.
All right. Welcome, everyone. Today, we'll be discussing Costco and our research and analysis of the stock itself. My name is Colin.
I'm Sam.
And I'm Michael.
And we'll be going over a quick overview of everything that we've done and what our research results are, and then we'll dive into the information and analysis that we did.
All right, so kicking us off here, our recommendation is do not buy. We believe Costco at its current trading price is overvalued. They're currently trading at $372.50, and we set a target price of $356 with a target return of negative 3.5%. So overall, Costco as a business, they're a wholesale retailer that offers discounted products in bulk to their members. Their business model relies heavily on returning members, and they have very low sales margins, which is offset by their nominal membership fees. So some key drivers for Costco, we believe membership revenue and imminent price increases, and then increased presence in the e-commerce market. So some risk that Costco has is, like I said before, extremely low profit margins, which requires Costco to have very high sales volume to increase their profit numbers. So taking a look at Costco's, on the left, their 1-year stock price trend and their 5-year, we can see that their PE ratio from 2018 to 2020 has been increasing by about 5 points each year. And in the trailing 12 months is at right around 34. And then their ROE has stayed pretty consistent over the last 3 years at around 25%. So just an outline of what we're going to go over today. We're going to break down Costco's revenue, their different revenue streams, break down their financials. We're going to look at their 2 key growth drivers, the first one being membership growth, and the second one being an increase in e-commerce. Next, we're going to go over our valuation and why we recommend not buying Costco at their current price and the risk that Costco possesses. And then finally, we're going to go over how Costco fits in the overall Spellman fund.
So again, just an overview of Costco. They're a membership warehouse that provides goods and services to their members at a lower price than their competitors by selling brand name items in bulk. So in 2020, their total revenue was $166.8 billion. Costco operates in 8 different countries, and they sell brand name products as well as their own in-house brand, which is called Kirkland Signature. They also sell gasoline, electronics. They even dive into the mortgage space with loans and refinancing, as well as home and auto insurance. So taking a look at their different revenue streams, as of August 30th, 2020, we can see that in-store sales makes up the vast majority of Costco's revenue, coming in at 88.2%. Next is going to be e-commerce, just under 10%, or $16 billion in revenue. And then membership fees coming to 2.2%, or $3.7 billion in revenue. And the biggest increase from 2019 to 2020 was e-commerce sales, with a 3.2% increase, as we can see below in the pie charts there.
All right, so diving more into their financials, and particularly their financial ratios. So first off, Costco's PE ratio has been a subject of debate for many reasons. It's extremely high for a company in the retail space, with it having been hovering around 30 for a number of years before it spiked in 2019 and again in 2020 as trading stayed high despite the fact that the pandemic hit and that earnings were affected by that. But over the trailing 12 months, Costco's PE ratio has remained pretty steady around 34, 35. Compared that with Walmart and Target, 2 of the biggest competitors in terms of overall retail, because Costco's market share is that big that comparing it to a company that's much smaller wouldn't make that much sense. So they're around double that of their direct competitors, which would be off-putting to, I guess, most people. But their PEG ratio is pretty similar to that of Target, both in the past year and in terms of future growth as well. As far as their other ratios, their price to book is obviously much higher than their competitors as well. But ROE, ROA, and those two, they're pretty similar in those regards as well. And in some cases, they're doing a lot better. And then obviously their net profit margin isn't going to be as great because they don't have great sales margins. So they're relying pretty much on revenue from memberships. And just another little tidbit, that they paid off a lot of debt over the last year during the pandemic. So their debt to equity ratios have improved drastically. They were around the same as Walmart there, and they dropped it to 0.5. So the first driver that we focused on is membership growth. Membership plays a very key role in Costco's profits and overall just their business model. So Costco's membership revenue only accounts for 1.7% of total revenue they gain, and it's close to 100% profit. Their membership growth rate falls around 5.63%. That's remained steady for a pretty good chunk of time. It's remained about 5.5, 5.6 over the last 3 to 4 years. And their membership renewal rate is up around 90%. So they retain a lot of the customers that they get, and they don't really lose hold of them ever. So near the end of 2021, they do expect a price increase. Their memberships right now are around $55 for regular membership and $110 for executive membership, and that's expected to increase. And on the next slide here, we show the membership revenue projections. So that 65.95, that jump from 60.95 to 65.95, that is due to the price increase, and we kept it pretty conservative with the $5 increase, although they could do the $10 increase to $65 for a regular membership, and that would obviously boost those revenue numbers. But overall, you can see that big jump there, about $500 million in membership revenue from 2021 to 2022. That will be a big year for them, and a big focal point for how they will do in the long run.
And then for our second driver, that's going to be e-commerce. The COVID pandemic shut down most shops that were non-essential, mainly due to the social distancing shutdown. E-commerce increased tremendously in 2020. Costco's online sales grew by about 49.5% in the last fiscal year, which ended on August 30th. E-commerce sales are not expected to hold at these levels, with everything reopening and slowly going back to normal. Because of this, e-commerce sales are predicted to decline by 8% over the next 5 years, and by 2024, we predict that Costco's e-commerce sales will grow by about 24% that year. Costco stated that it is after low-hanging fruit with its e-commerce strategies because of the sharp growth in 2020. E-commerce revenue jumped from 9.8 billion to 16.1 billion, and sales made up 10% of Costco's total revenue in 2020, which is up from the 6.5% they reported in 2019. And then here's just a simple graph showing the e-commerce annual decline in growth rate over the next 4 years. Costco is making a push for more e-commerce strategies. One of those strategies is allowing non-members to be able to purchase items off their website for a non-membership fee. This allows customers to bypass the annual membership fee and purchase online or Costco brands online like Kirkland's and buy their brand name items. The fee is a 5% surcharge over the posted prices that they have online. This is a good strategy to allow anyone to shop at Costco online due to the pandemic shutdown. E-commerce sales everywhere rose tremendously, and the growth rate in 2020 is just not sustainable. With the vaccine, the business is starting to open back up. And then for our valuation, our EPS is growing at about 9.8% annually over the next 4 years. Membership revenue accounts for about 60% of the total revenue for the company. This is expecting to decline a little bit with the rise of the e-commerce revenue. And then their other revenues from their other business dealings stays at around 34%. And then their membership growth rate is expected to reflect in 2022 what the e-commerce growth rate did in 2020 to 2021. It's just kind of expected that they would experience a sharp increase in members from everyone shopping online at their store, and then it's expected to level off to about 5.63%. Then we can see the 8% decline in the e-commerce growth rate, and then their growth for their other business dealings again is going to be around 9.85%.
All right, so moving on to the cash flows valuation, and this was a big part of why our decision ended up being not to buy. With their net profits, obviously they are increasing around 10% a year, thereabout. So that's not a major concern. But what is a major concern is that their capital expenditures, they stated in their 10K this past October that they would aim to be around $3.1 billion in capital expenditures in 2021, and increasing that at about the same rate as earnings are increasing. So that's how we calculated out their, I guess, increasing growth rate in capital expenditures. And that's money that's not going to be flowing to the investor and not going to be paid out as dividend, especially considering that Costco paid out a $10 dividend per share in December 2020. That probably won't be coming along in the near future as well. So that's obviously something big to consider. But as far as everything else goes, their depreciation and long-term debt, that all looks good, especially considering that their debt isn't really that big of a factor anymore because they paid a lot of it off during the pandemic. But overall, their free cash flows and the present value of those free cash flows doesn't really give too much great value. And on the next slide here, you'll see that their future cash flow values are around $160, put them around $160 a share on value for that alone. And that's for the amount of income that Costco gets. They're just not worth that premium price that they have on the market right now. But with the PE method, they're hovering around $370, $380, and that's about the range that they're trading at right now. So it's not too outlandish to say that their earnings at their current premium wouldn't be worth it. But considering the fact that strictly based on earnings, they aren't valued as much, it pushed us towards our sell rating on there.
The risk to Costco's revenue can happen from a variety of different reasons. Low profit margin is a big risk. Costco's in-store sales profit is very slim. Increased competition in e-commerce and wholesaling in general is also a little bit of a risk for Costco. Competition risk correlates with membership exclusivity because you're required to have a membership to shop at Costco stores. This poses a risk if members choose not to renew their memberships. But Costco has about a 90% membership renewal rate. Their limited product mix could also pose troubling. Some customers prefer a variety, and some are willing to pay to have more choices to do so. And the potential minimum wage increase poses a little bit of risk too. They just stopped paying their pandemic pay increase for their hourly workers, which was about $1. So Costco saved on that. And then for our portfolio recommendation, we do recommend buying Costco at the price of $321.03, which is about 10% below our target price at $356. We recommend, and to do so, Apple makes up about 10% of the portfolio right now. So we recommend selling about 32% of Apple shares. That 32% of Apple shares is roughly about 101 shares of Apple at the price it is now, to buy 41 shares of Costco at our price of $321. This would bring Costco up to about 3.2% of the portfolio. To bring it up to the 4%, which is around what its frontier weight is, it's around 4%. We could use the additional $2,800 in cash in the fund. This would allow to buy 8 additional shares at that price of $321. But right now, we do give a sell recommendation and not to buy Costco. Just from the data that we analyzed, shows Costco's earnings levels aren't worth the premium price of the stock that it's going for right now.
All right. And this is the correlation matrix that we produced from Costco's just previous price history. As you can see, there isn't a ton of correlation as basically they are a pretty unique stock, and they are not really they don't fluctuate quite as often in terms of price as, say, a tech stock or an automobile manufacturer might. But what they do have there, they make up for in stability and just regular earnings growth that they have kept pretty solid over the years. So from our findings, we see that the efficient frontier weight for the Spellman fund would be around 4.3%. And considering that our recommendation would bring us to around 4%, we thought that would be pretty appropriate. So over here, we can see the highest correlations from the fund are CVS and Booking Holdings, which have done fairly decently. But the lowest correlations are Boeing and Nexstar Media, which Boeing hasn't done quite as well. And they have been a pretty big outlier in terms of the stock market as a whole. And the same with Nexstar Media, but on the opposite side, they've been a pretty big driver of value for the fund. But then again, Costco is very unique. They don't really correlate with a ton of stocks in the fund right now. So with that, Costco would be a great addition for a stable consumer cyclical stock, and overall just a great stock to provide some stability and decent earnings for the fund, and would be great to exchange it with a tech stock, particularly Apple, because Apple is very overweighted in the stock in the fund, and would be great to get rid of a few shares there. And again, the price is currently very high. Just today, or excuse me, just yesterday, the stock jumped $12 in its market value to around $385. So again, it's very highly valued on the market right now, and it doesn't exactly appear to be a great value right now. But Costco's business model is very sustainable, and it looks to be highly profitable for in the years to come. It's just not a great value at the moment.
All right. So just to summarize our presentation, the positive takeaways: Costco offers a very high EPS growth, particularly market share, protects against the economic stability. And some negative takeaways: obviously, Costco has low cash flows relative to their very high stock price. And for a stock in a consumer cyclical sector, they're very expensive. So once again, we're recommending a do not buy. And we believe that the PE method gives a better indicator of value, but that could change in the future. And the recent stock price jumps in the last couple of weeks just pushed the stock out of the value range. So once again, the target price of $356.76, we're recommending a buy at about $321, which is 10% below that price. And we'd now like to open it up to any questions that you guys may have.
All right, nice job. So yeah, we started a little late on this one, so we can go for 20 minutes with questions then.
First of all, good job, guys. As a card-carrying member of Costco, I've been keeping an eye on this one, and I agree with your assessment. I think it's probably a little overdone. I thought it was interesting how it reacted to the last earnings report in March, and since then has come all the way back. And I can't justify the valuations either. So first of all, kudos to you guys for taking a look at it and not trying to curve fit and find a reason or an excuse to buy this one. I think you're right in your assessment, and it is probably one that would fit well into the portfolio at the right price. But like I said, don't think it's today. I don't have a ton of questions. I wanted to really comment on, the fact that you stuck with that valuation, and if you can't make it work, great. I guess the one thing I would question as we look forward as a long-term holding, is there a big moat around this? I mean, I remember when Walmart introduced Sam's Club, and then all of a sudden it seemed like Costco kind of popped up out of nowhere, at least for me here locally. But is it possible that a Target or another retail brand could introduce a similar sort of wholesale chain? Any thoughts there?
I would venture to guess that it would be tough considering, I mean, Costco's obviously very established in the market, and overall they have a 15% market share in retail alone. So obviously they're the biggest wholesaler. They're really the only wholesaler in the game that's publicly traded besides BJ's on the East Coast. But I mean, as far as someone branching into it, I don't think that's that big of a threat considering, I would probably say the bigger threat would be Amazon. And I mean, obviously Amazon's a threat to most businesses these days, but just because they have the capacity to, I guess, change in that way and be be able to sell things at a lower volume or lower bulk that consumers would be taken by value for.
All right, so maybe I asked my question wrong in hearing your answer.
Oh,
no. I asked it the way I wanted to, but as I listen to your answer, I think I can kind of now start to justify the PE, the higher PE. And so what you did was answer to me why somebody might be willing to pay 26, 28, 30 times earnings for a retailer. They have that moat. It's not an easy business to get into. There's low margins, so why would you want to? And it seems to be Amazon proof. If I look at earnings over the last 5, 6, 7 years, they seem to continue to perform despite an environment where other retailers have struggled. So still think it's a little overdone, but I think you're right in that it, not unreasonable to pay 25 or 26 times earnings. So, all right, good. I'll try to think of another one.
Can I expand on that a little bit?
Yeah, go for it.
And I'm going to ask about margins coming up here, but I'll hold off.
All right, sounds good.
Great job. I thought you guys did a great job. I would agree with most everything Tyler was saying there. I just wanted to talk about, like, if I think about it, I am a Costco member as well. I take my kids there. It's more of an experience. And I think that's how they market themselves. They have the samples, or at least they did prior to COVID, and it's more of an experience. So I have a lot of questions more about the e-commerce. That could be a huge growth area, or, is that why Amazon hasn't taken it yet? Because it's not really an e-commerce. Think about how large of things you're buying, shipping costs. How are they going to do that? Where Amazon, you pay $100, you get free shipping. Did they talk about any additional price you could pay as a Costco member and get free shipping annually or anything like that? You think about Walmart, they bought Jet to get their e-commerce business. I guess I had a lot of questions around the e-commerce and the growth. And just to make this question even longer, you had a comment about capital expenditures, and that hopefully leads to future growth. So I guess my question just was, hey, CapEx isn't the worst if it's for a good thing. So I was curious if they had a lot of new locations that they were expanding to, or what that CapEx was for. Going back to that one, but I'll let you answer those in any order you want. But I thought you guys did a great job, and sorry for the long question, but
it's fine. I'll touch on the capital expenditure part first, and then let Mike handle the e-commerce side of it. But the capital expenditure side of it, it appeared to be more so just like structural stuff with warehouses, making them more efficient. And obviously, they're trying to, a lot of those capital expenditures will be to enhance their e-commerce, I guess, footprint as well. Because it is at this stage kind of expensive to get into the game as far as that goes. But as a whole, I think they are trying to open more stores. but that also goes hand in hand with the membership increase as well, which we I guess mapped out. But overall, the capital expenditures do seem to be kind of maintaining things rather than I guess expansion.
I can kind of touch on the e-commerce a little bit. So in last year in March of 2020, kind of right before the brunt of the pandemic happened, Costco actually bought like a shipping and handling company called Innovo Solutions. And that really helped. Like before, they weren't really, they didn't have the best management of e-commerce and they weren't really big in that space. So buying this company kind of helped transform their supply chain to make it more efficient and everything. And I think it's really cool what Costco does is they, not just members can buy on their site, non-members can buy in bulk on Costco's website. They just have to pay like a 5% premium. And that's all profit for Costco. So that's a really big growth factor as well.
But any talk about current members, you know, getting free shipping or for a fee or anything like that?
Just checking on the website here for their e-commerce, they actually put the shipping price into the product price. So, yeah, I'm guessing everyone's going to pay that shipping price. You're just not going to actually see like a shipping price to ship it. And then on top of that, if you're a non-member, you're going to pay a 5% surcharge on top of that.
Okay. And then just last one, you know, if you said the two membership fees are, I forget exactly, 55 and 110, and
Yep.
the average was 60 or 65, it sounds like everyone has the lower membership, or 90% or so. Is that accurate?
Yeah.
Yeah, we had the I guess lower membership fee growth, like the price hike. We could have done the $10 price hike, and that would have pushed the membership revenue up a little bit more. But we decided, just because it's not really feasible that Costco would increase it by that much, that it was just more so thinking that we would try to be conservative with that and try to make it more realistic.
I just realized I'm sorry. By the way, I'm Kevin Spellman, coach, or Dr. Spellman. I'm going to do this because I realize I need to make a phone call. Otherwise, I can't get my taxes done this weekend. So, but I'm going to ask a question. Well, the bank didn't send me a statement, and they were supposed to send me an email. And I called them earlier today, and they didn't send it. So, anyway, the question is, margins come up quite a few times. It came up earlier, and then right when you said this, or one of you said this earlier in the presentation, you say low margins is a risk, and then it was on the last slide of the risk too. Mm-hmm. So I'm going to ask you a really easy question. Do you think Walmart is a really risky company?
No.
Same margins as Costco. Sorry, let's just keep going. I got a bunch of examples.
Okay.
All right. So Walmart is not exact same margins, about 2.7, 2.4. Do you think Kroger is? Grocer. No, 2.4 margins. You think Amazon's a really risky company that's going to go out of business? Now they had, like, until 2 years ago, they were under 2% margin.
Yep.
So and bookings, by the way, has negative margins right now. CVS is the exact same as this one, Costco at 2.4%. So that's just to make a statement. When you made one of you, I think, it was you, Colin, you said they make up for it in volume of sales.
Yeah.
So you are 100% right. They're most distributors that add just a little bit of value, they make very low margins, and they just sell a whole bunch of stuff to make up for it. Mm-hmm. Okay, so that's just me on a teaching lesson to say that I don't really call that a risk. It may actually keep others out of the business, but there's grocery stores can pop up. So, and so the question now becomes, why does this company trade at such a high PE? Because the PE, the price, is the market's telling you something. You may say it's overvalued, and I would have a very hard time buying it at this multiple. However, it has a very high ROE because they have that volume. So what is the market thinking that you disagree with? And I guess the second question I'm going to ask you too, what price would you buy it at? Because you seem to like the business all right.
Yeah. I guess that's fair. I'll touch on
all of you should be answering this, right? Not just one last person. So what is the market thinking and what price would you buy?
Mike, do you want to take that one?
You can come back later if someone else has another question.
Rephrase that question here again?
PE is like 35, 37 times, which is 50% more than what we pay for the average company. Why would the market be paying that much for this company?
I think.
And then the second one is, what price would you buy it at?
As far as the buying it at, I think it would be the $321 that we had there. But I would say it has something to do with I believe Costco does like their share buybacks, and they are one of the they are the only like company that does what they do as far as the wholesaling. Amazon is kind of like them in their e-commerce, but Amazon doesn't sell like the dry goods that Costco would sell. Costco also it's mainly like the grocery store. They also have like those novelty items like the hot dogs at their businesses with their the gas stations, which they don't make any money off that gas station. It's just there to draw customers in. They have also a very high membership renewal rate.
You said a bunch of things here, and then you summarize it there. A very high customer renewal rate. They have a low risk business model.
Yeah.
So people may be paying up because this company is not going away. You said it earlier, it had a moat. And they have all these things. They don't make money I'm sure they don't make money on the hot dog thing too. Certainly when my mother says, can we split it in half and you give me a free bun? I just can't believe she did that.
Yeah. So, yeah, I actually have.
We're cheap in our family, so I'm not that cheap though.
Yeah, I know they like my mom and my dad, they both have Costco memberships. I have a few friends that work at Costco because one of my buddies, he actually works in like their automotive repair, and he says they always have people there. And then again, like most of them are going to have the membership, and they're going to do their shopping there while they're getting tires changed or something like that. They also pay their employees pretty nicely. I don't think anyone gets paid under $15 an hour that works at a Costco.
Charlie Munger owns this. It's like that and Berkshire Hathaway are, I think, his favorite positions, right? The earnings have doubled since 2015. And that could be the share buybacks, right? They have very high return on equity. And they've had some growth. You said they're growing earnings about 10%. So they get, above average growth, low risk, moat-like business where customers come back, kind of dominant, so they have buying power. But it, still 50% more than the average for the market. And it's not like it's growing 20% a year. So I don't disagree with your conclusion, but I think that's all the things that you said probably comes into low risk and decent growth. And maybe people are expecting that same growth, that almost double earnings since 2015 happen in the future, and it's not going to happen based on your analysis. So it's overvalued. All right, so that's good. I need to call a bank, but I'll be listening.
All right, sounds good.
Sounds good.
And I'm sorry I came late. I taught until 2, but it's kind of our last day of class, so it really went to about 3. I made them stay an extra hour, and so I apologize. But these students are with me for 2 years, and I wanted to give them some parting words. So sorry I was late.
Oh, no, completely understood. All right. Do you have any other questions?
I don't know if it's a question or a comment, but I wanted to add, when you talk about the membership fees at the 2 different levels, and there was a number there, and Eddie was highlighting it. I don't know if it's factored in, Eddie, but I have the higher one, the $110 one or whatever it is. It comes out to $125, and then based on how much you spend, you get a portion rebated to you. So 2 years ago, when I bought all of my patio furniture and they shipped it to my house, I got a big check. Last year, with just the normal spend, I got I got a check for $126.25 or something. So it covered my fee plus 65 cents. Still have that in my pocket. So I don't know if that takes out of the net number and that's why it's smaller, or is it Costco's preference to actually keep people on the lower plan because they don't have to pay back any kind of a rebate to that membership? So, but either way, the membership renewal rate is a positive, as Kevin was pointing out. And I don't know that we should read too much into the $60 average price when you compared 50 to 110, because I think there's somewhere in there they're factoring in the fact that the higher membership gets a rebate afterwards. So anyway, those are more comments than anything.
I'm glad you actually brought that up, because I'm in the same camp. I think you do have some high volume shoppers there that end up getting more money back than what the membership fee cost them. So I did not know if that was factored in there, but I was thinking, as I saw, the way I was reading that slide was that the majority of people pay for the lower membership, and they're always trying to upgrade people in the store. But that kind of gave me pause, thinking, they shouldn't increase that lower one too much then, because if they're getting a bunch of people that don't shop there that much to pay that big membership, that membership fee in the lower end, that's maybe they should increase the higher end one, more. I don't know. I just thought that was interesting.
Yeah. So I don't know if I'm in that calculation as 0 or as 110. So if I'm in there at 0, then maybe they have a lot more $110 memberships. If I'm in there as 110, then it makes sense that it's still skewed towards the lower end of the membership spectrum.
Mm-hmm. No, I believe the way we calculated the average membership cost was just the business memberships plus the obviously the household memberships, and then multiplying those by their rate. So I don't believe that you're a 0. I believe that you are your full 110, 120, wherever that is. But yeah, no, as just in general, that's just how we got that. It's just a aggregate price there, and yeah, that jump we probably could have maybe I guess done a little bit of a rate change or something like that, as more people might upgrade their membership, stuff like that. But that was just our basic level calculation there.
So are there rebates in there then?
No, I don't think so. I think they separate those out from regular membership revenue.
Okay. And then last question. Sorry, Tyler, do you have another question, or is that just your comment?
That was a comment. I was going to ask about the dividend, but why don't you fire off yours first?
Mine's a quick one, and then so you mentioned they paid down a bunch of debt.
Yep.
And they don't have a huge e-commerce business yet. Might look to invest it. Did they talk at all about, freeing up their balance sheet by paying down debt so they could take on an acquisition for potentially some e-commerce platform or anything like that?
Not in their earnings call that we saw. More so in that 10K, it was just kind of describing this is what we want to spend on our business, and we're putting it at that amount so that we know we want to stay within that budget and kind of work our way towards building something that we are consistently growing rather than doing it in random intervals, I guess. And then Tyler, you said you wanted to discuss the dividend payout.
I did. I'm also looking at the debt situation, and it looks to me like they actually took they paid down some long-term debt, but they took on some short-term debt in 2019, and then 2020, it appears that they paid off the short-term debt and shifted it right back to the long-term plus some.
Okay.
So I don't know that that's the. I'd have to look at that one. It seems like it was more of a just
Yeah,
a refinancing exercise versus a shift in it. But they may be commenting about debt repayment going forward, and it's not captured in the numbers that I see that are going back to August of 2020.
Yeah,
So,
maybe, and we might have calculated at one of the points where they had paid it off and not taken on the short term or the long term one way or another. So that might be something that would obviously need to be looked into.
So
great. All right, so let's just talk a little bit about. You mentioned they were shareholder friendly. They were buying back shares and that kind of thing. What's your outlook? Your thoughts on the dividend that the company pays? And some of the special cash dividends that it pays periodically, and how we should kind of view that from an investment perspective.
So for their dividend buyback program, they had a program that was like set to expire that they like they restructured it, and it had like. It says right here they had $2.2 billion worth left on that share buyback program. So like that could have been like a shift from the short to the long term debt maybe. But they do have a share. They are Costco is doing a share buyback program of $4 billion, and that goes till April 2023, and then I believe they pay 10 cents a quarter. Or no, that's way off.
It's a 70 cents per share.
Yeah, 70.
And what else? Here's what I'm driving at. Every now and then, and I'm going back to 2013, 2014, they'll pay a special cash dividend. They get to the point where they've made, for lack of to oversimplify, they make so much money, they don't know what to do with it. And they give their investors special cash dividends. In 2012, they paid $7 a share. They did $5 in 2015, $7 in 2017, and $10 a share in 2020. Now that comes right out of the share price, right? Because you're sitting on that cash. So the combined value of the company is, it's included that. So when they pay a $10 dividend, you expect the stock price to go down by $10 once it's been paid out. But it is a very shareholder friendly stock, and that they're raising their dividend now. It was 70 cents a quarter. You're right. It's now 79 cents a quarter, payable on May 14th. And like I said, there was a special cash dividend every couple of years on top of it. So I do think, when Kevin was asking the question about why pay that premium, and I was asking the question earlier about why pay that premium price, there's more and more reasons to do that. Very shareholder friendly. You commented on it, and that's what they're doing on the dividend side. They have that moat. They do some of the things that Amazon doesn't do. They have that renewable membership. So I think there's a lot of things where if you really wanted to push a little bit harder, I think you could make a case. I'm with you. I think it needs to be bought lower, but maybe that valuation is reasonable. I don't know. So that's all I got.
All right.